Hello, my name is Chris Weston. I'm Head of Research here at IG. Today's webinar, we're going to look a little more closely at understanding correlations in the markets and how you can use them to greatly affect your strategy and your profitability going forward. Before we go anywhere, I think we need to have a look at the disclaimer. It's important you do read this and understand that CFDs are geared products and can ultimately can result in losses that exceed your initial deposit. We need to understand the leverage that's involved. So please do take a bit of time to read this disclaimer. So what are correlations in markets and how can we use these to our advantage? Well, a lot of people trade Newcrest Mining, which is one of the big gold stocks in Australia. Of course, we need to have a look at how that's correlated to the gold price. You may say to yourself, well, that's an obvious situation. You know, gold moves up, it makes the profitability of Newcrest increase. Well, that is the case, but of course there's always corporate issues, earnings downgrades, company director issues. So there might be another stock, for example, which more closely tracks the gold price, say Kingsgate Mining, or a US firm, for example, such as Newmont Mining. So we're looking for stocks which can potentially correlate much more closely with an underlying commodity. We can use them very closely for diversification purposes. You might have heard of strategists saying to clients and saying to people, you need to have a diversified portfolio. Well, that is the case. I mean, during the GFC, we saw it quite clearly that a rising tide lifted all ships. So if we saw a good piece of economic data, we saw the Aussie dollar rallying, we saw gold prices rallying, we saw the oil price rallying, we saw stocks rallying, all in unison. So that's what we call a rising tide lifts all ships. Now, in terms of diversifying your portfolio, it's important, and a lot of people do believe that you should have exposure to different parts of the world, different geographies, different asset classes. So using correlations, you can actually work out and therefore understand how to diversify your portfolio and work out how closely correlated different stocks are to take advantage of that diversification situation. We can look at divergence. Will one asset class play catch up with another? Now, another situation which we've seen at the market in the markets from time to time is the correlation between Brent crude and West Texas Intermediate, WTI. Some people like to trade the spread between the two. When the spread blows out too wide, we like to see traders like to buy one and sell the other, like a pairs trade. We see that with the FTSE and DAX. When one spread becomes too wide against the other, we like to see people looking to buy one and sell the other. So understanding divergence can also be another situation which we can look at correlations. Now, some of the correlations in the markets that I like to look at, which can be a little bit more tricky to ascertain, you can't really see these on our charts, but one of the ones which really has been in focus over the last 3 years, which I think is really symbolic of everything that's going on in the market, is the S&P, the world's institutional benchmark, against the Fed's balance sheet. As the Fed's expanded its balance sheet by printing money and buying US treasuries and other assets, we've seen the stock market pushing nice and high. In fact, the S&P at the moment is at record highs. We've also seen the dollar under pressure for large periods of that, although we are seeing a slight uptrend over the recent few months. So this is a really interesting correlation, an example of what we're looking for. And if the Fed looks to taper off in its bond purchases as we go forward, will the stock market come under duress? Because this is the correlation that we're seeing at the moment. So this is an interesting one that we've been seeing. The chart that I've got in front of me here is the Aussie dollar in the grey line against the global positioning that we see from hedge funds and other leveraged firms, and that's the orange line. As you can see at the moment, positioning has never been this short. These are the record short positions that we've got in the market. So we can see here a correlation between the Australian dollar and the positioning that's in the market. Futures traders have to report their positioning, and this is the net positioning that's resulted at the end of the week. What we can see here as a trader is I'm looking out for something that has one-sided positioning. As you can see now, the Australian dollar has had a big fall, but positioning is very stretched at the moment, and therefore we also could see subjective profit taking and short covering coming through. So this is another idea of correlations that we're seeing in the asset class market. Using our charts, and I'll show you some examples in 2 minutes, but this is a really strong correlation that we can see at the moment. The Japanese market, the Nikkei, against dollar yen. Now you can see for large periods of time throughout 2011 into 2012, they moved very step by step, tick by tick, and they've seemed to move up and you can still see correlations, although one is outperforming another. The reason being, a very fundamental reason between the two, is we know that every 1 yen move to the downside results in more profitability for the top Japanese companies. In fact, if dollar yen went from 101 to 102, we know that influences and impacts the bottom line of the top 30 exporters by about 2.7 billion US dollars. So clearly there is going to be a very strong correlation between these markets. We know the Nikkei is effectively a derivative of the currency market. The chart here, we've got Newcrest Mining, one of Australia's big gold stocks, against the actual underlying commodity that it mines. We know that Newcrest Mining is by large an all-out gold play, so you should expect to see a very strong correlation with the gold price, and that's for a large period of times. On this weekly chart you can see a very strong move up, and then you can see the divergence that's taking place now. So how do we place a trade? How do we actually look at the correlations that are in the market? I've just shown you some graphs there. Let's have a look at how we can actually influence this. The first thing is, this is the platform, this is my platform, is we need to actually bring out the asset class of choice. So we go on to find indices, and I'm going to actually have a look at the ASX 200 and the correlation that has with the currency, the Aussie dollar. So if I bring up the Australian 200 cash and go to Pro Real-Time Charts, now just for saving time, I've actually loaded my own chart here. So this is the result. I'm going to put this chart on a daily chart. I'm going to keep it over a couple of years. Now if we right click on the chart, go to compare security. Now in this box we need to actually bring up the asset class. Now this needs to be exactly as you see the asset on the platform. So I'm going to go to spot FX a dollar against the US dollar, and you can see it's predicted exactly what I need to do. So I click on this, and you can now see two assets have come up. The compared security is the Australian dollar. The original one we had was the Australian market. So what I now need to do is I can change my colours if I so desire. I'm going to have my down candle as a black candle, and you can see the chart there. We now can go through, I can change this to a line if I want to have it as a line chart. I can have it as a histogram if I so like. But in this case I'm going to have a candlestick so that they're comparing apples with apples, so to speak. I now need to go to price, so I click on price, and the important thing here is that I remove this vertical auto scaling. Now I need to have a look at the scale type, and I can change it to whichever type I like. Now what I'm actually going to do for this purpose is actually look at the performance and the outperformance that the Australian market has had against the Aussie dollar over the last year. So we hit on the relative scale, and then we click on the price at the date below, and then we can change this to the beginning of the year 2013 and press close. So as you can see, from 2013 the chart is now looking for the outperformance that we've had. The Australian dollar has fallen 11.7%, whereas the ASX 200 has gained 9.36%. So if we scroll out, we can actually see large periods of time where the Australian dollar has been extremely correlated with the ASX 200 because they've been riding on the same thematic, risk on, risk off. And as you can see into the latter stages of this year, you can see that clear diversification. The market now is clearly saying that a weaker Australian dollar is good for the Australian stock market and the exporters that are in play. If I have a look at the Nikkei, and we're going to look at the correlation this has with dollar yen as I showed you in the chart earlier. Again, we click on compare to security. I type in spot FX dollar yen, and it brings up the predictor. If I go to price, click off that auto scaling so it makes it come onto the chart. I click on relative scale just to compare the price from, let's say, 2010. You can see now that the correlation is very, very strong, and again you're moving there. So what do I see from this? I say to myself, if I'm trading the Nikkei, I still need to have a very, very strong view on dollar yen. However, which asset would I use? Generally you're looking for trade the Nikkei over dollar yen because the performance is greater. You can see that this is a higher beta index, therefore as both go up, the Nikkei is generally going to outperform here. And now if I go to Newcrest Mining, and if I want to compare this against the gold price, I right click, compare to security, type in spot gold because that's how it's written on the platform, choose my asset there, again I just want to make sure that everything's paramount. I want to change this to be black, just prefer the colouring. Go to my price, make sure that the vertical autoscaling's unticked, that way we overlap the charts a little bit better. If we go to the relative scale, and again we're looking for the performance of a certain time. So what we're going to do on this situation is we're going to have a look at Newcrest against the gold price over the last, or since 2007. And you can see there the performance of the two charts from 2007. We can scroll out if we like. You can put this on a weekly chart. And you can see that there's a very strong correlation, but as you can see into 2010, Newcrest Mining, the gold price certainly outperformed. And as you can see, there's corporate issues came through, and Newcrest Mining significantly outperformed the gold price, underperformed the gold price, down about 53% compared to the gold being up 119% from 2007. So we can play around here with the different time frames and have a look at the stronger correlations that are in the market. You can see there that now we're seeing a very strong correlation between the two, and we can now use that gold price as a much clearer indication of where Newcrest may travel in the longer term.